Press the bell icon on YouTube and don't miss another update.
This time, RBI issued a circular on the 12th of February that put an end to a number of restructuring schemes for borrowers that RBI had. It said that banks now have to go through the bankruptcy process whenever there is a default on a loan. What this did was to change the way banks used to recover loans. Now they could sell companies, they could go through the bankruptcy process and go through a process that was time bound. The question we're going to discuss today is, should this be the way RBI issues circulars? Because this circular came as a big shock to markets. It came as a shock to the government as well, because there were a large number of public sector banks that had bad loans. These loans now, instead of being evergreen, had to be taken through the bankruptcy process. The banks had to say that, sorry, the borrower has defaulted on this loan and I will take it to the bankruptcy process. It then meant that banks looked like they were very weak, that they had a lot of non-performing assets. This regulation making process in RBI should not be so abrupt. What really needs to happen is that RBI, like other regulators, should discuss what are the regulations that it is going to make. These regulations then need to be taken to the board. So let's look at two things. Let's look at how currently the law requires RBI to make processes, and second, let's look at what should be done instead. The first issue is, what does the law require RBI to do? Now, this very controversy about the February 12th circular actually brought this question to focus. Last year, after this circular was passed, after banks had to quickly respond and come up with lists of their non-performing assets, it seemed, or there were reports, that the government tried to say, no, this February 12th circular needs to be reviewed. So, what are the ways in which RBI makes regulations? Today, the way it's done is, it passes a number of circulars, it issues guidelines, it issues directions. In fact, this circular was under a direction that did not even have to be approved by Parliament. It was not even something that is known as subordinate legislation. That is legislation that regulators make under the powers that have been given to them by Parliament. It was not even that. But in general, there are guidelines, there are circulars, there are master circulars, and then there are these directions, which could then be passed or issued by the management of the RBI. Now, what the RBI Act currently says, Section 58 of the RBI Act says, is that the RBI board has the power to make regulations. However, regulations, as we know, and as this controversy brought out, have not been made by the RBI board. So how is that possible? That is because the law and the same Section 58 also allows RBI to give to a committee of the central board all its powers. It allows it to delegate all its powers, which it has done so. What is this committee of the central board and who is a member? Not the entire board. The committee of the central board is supposed to meet under general rules that have been framed under this section every fortnight. And who is supposed to attend? Interestingly, it can be attended by whoever happens to be in the area. So if there is a member who happens to be in the area, that is in Bombay, or wherever else the governor or the deputy governor who is holding this meeting is, then that person is part of that decision making process. Now, this process is not something that works today, either in India with other regulators or with best practices or with international regulators. Nobody makes regulations like this. It's important to understand that regulations made by regulators, rules made by them, have the power of the law. Such legislation, what is known as subordinate legislation, which is not made by Parliament but by regulators using the power that Parliament has given them, actually need to have checks and balances, because they can't be made by officials who are not accountable to the public, because this is after all law, and law and legislation is the domain of Parliament. What are these checks and balances? Usually these are done through having the board make these regulations. The board which has an oversight over the management, and not just allowing an unelected management to make subordinate legislation. The current Act, 1934 Act of the RBI, does not incorporate all these best practices. That is why it allows the board to delegate all its powers to a committee which may be attended by anyone who happens to be in the area. This, of course, cannot work today. The Financial Sector Legislative Reforms Commission, which had done a full review of all the laws of regulators, including the RBI Act of 1934, has suggested a number of ways through which subordinate legislation or regulation making can be improved, checks and balances be put in place, and these are something that need to be revisited, particularly in the light of the February 12th circular, which really changed the way banking, debtors' rights, and the process through which banks declare their non-performing assets are done.